Welcome to our YouTube live session, and this is our usual format. So we have an hour together, and usually I'll just start off by talking a little bit about what's going on in markets, and then I hand over to you and you can ask me any question you like. And so let's start off with what's going on in the last 2 weeks since we last spoke. Clearly, this is a very volatile time for equity. We have seen some fairly horrendous sell-offs in some very large cap companies like Facebook and PayPal because they disappointed with their earnings reports. And I think that's probably going to get worse until it gets better because, we are seeing a fairly good earnings season for Q4 of 2021, which is what we're seeing now, but it'll probably get a little bit worse in Q1 of 2022, which we'll start getting results for in about 3 months. And if that happens, then, there could be quite a choppy period, put it that way. So I think if we look back over 6 months, it's roughly flat. The Nasdaq, the S&P's up. Yeah, so if we look over a year, actually, the Nasdaq is up about 4%, and the S&P's up about 12%, and they've given up quite a lot of those gains since the beginning of this year. So year to date, the S&P's down almost 8%, and the Nasdaq about 12%. So it certainly hasn't been a great start to the year for risky assets. And I don't think it's going to stay terrible for a long period of time because, as I say, I think the backdrop isn't terrible. Growth is okay. Earnings seasons will be okay in aggregate, although there will be some names which get heavily battered. And I think one of the problems is that there's so much concentration in the Nasdaq and also in the S&P, although to a lesser extent in the S&P. So when one of these names does get whacked, like Facebook, it's such a large proportion of the index that it's going to have a big dragging effect on the entire index. So that concentration is never good. It always ends as a correction, and that's pretty much what we've seen so far this year. I think in terms of content this week, we've been very busy. We have launched a podcast. We're now on episode number 5. So let me just share my screen so you can see this. This is what the latest episode's about. And this is my colleague, Michael Pugh. And he's got a genius for coming up with titles. So the latest title is It's Not ESG Being Green, which I thought was very good. I love that. And the previous one was Tech Shares on the Titanic, also good. And that was talking about the big sell-offs that we've seen due to a lack of liquidity and general nervousness. So, yeah, definitely have a listen to the podcast. I think you'll enjoy it. It's much more informal than a normal video, and we can really kind of let our hair down and discuss some of the topics in depth. So have a listen to that. And please vote for us on Apple. So if you rate us highly, it helps us a lot with the podcast. We've got a lot of positive votes on Spotify already, not so many on Apple Podcasts. So please do leave a review for us. It helps us a lot. And yeah, I guess the other point is that, at the moment, there's a lot of political instability in, a lot of worries actually about political instability, although the reality is so far is that the Ukraine hasn't been invaded and people are very nervous about it. People in the West more so than in the Ukraine, oddly. But still, we have to just wait and see what happens. Generally, all I'd say is these events tend to be fairly short-lived in terms of their impact on equity markets. There's a fear response, which is immediate and usually sometimes sharp, but usually it's a short, sharp shock and it doesn't last for very long, and then markets recover. Unless they start to affect earnings. So something which would affect earnings would be something colossal in nature. And to affect US earnings is very unlikely. So I think I'd discount any kind of initial fear that there's going to be based on what happens in the Ukraine. Of course, if it escalates, then all bets are off because a shooting war in Europe is not something that would be good for risk appetite. So that I think is quite unlikely, but still, it's something to watch. So also another piece of content that we put out this week for members, for Patreon members, was about yield curve and yield curve inversion, because at the moment the yield curves are getting much closer to inverting. The short end of the curve is moving up very sharply in the US, for example. The long end of the curve not so much, and so that the overall effect is to kind of flatten the yield curve, and then if the short end goes up enough, it's going to invert the yield curve, and that usually comes just before a recession, although it's not a great indicator, I have to say. But still, it's one which many people are interested in, many people watch it, and it's important to understand it. So that's what we did for Patreon members. So let's get started on the questions. And the first one, which is, or I should say, if you're one of our, if you do a super chat, you get pushed to the front of the queue. We'll answer your question first. If you're a member, also, if you're a YouTube supporter, I should say, we also answer your question first. We can tell you're a YouTube supporter because you've got a little crown next to your name. If you want to become a YouTube supporter and help us financially, then the amount we charge is very minimal, but it does help us a lot if you do that. So just click on join underneath this video to support us on YouTube, and then we'll answer your questions first. So the first question is from Ola Yorokan, who is one of our YouTube supporters. Thank you, Ola. Who says, "Hi Ramin, hope all's well. Will you still continue to buy broad index funds or hold back in cash or other assets?" So yeah, I mean, I still have index funds. That's my core holding. Sometimes I buy single stocks, sometimes I buy commodity funds, but it's always funds and usually broad index funds. So I'm happy to do that. You know, I just think that's a very simple way to invest, to keep it diversified, to pay very little in fees. And, you know, I'm happy to keep that exposure in place. Would I hold back cash? No, because you never know when markets are going to rally. So most of the time markets do rally. So I am happy to carry on drip feeding into my portfolio. And in fact, I've got a late payment actually. I should have done a payment into my Vanguard account on, I think it was on Friday this week. So I should put the trade in today. Friday last week, so I'll put the trade in today. Yeah, so I'm carrying on drip feeding into my global equity fund, and you know, I'm going to build up to 80% equity and just leave it. That's my plan. Because I've shown, if you actually look at the video I did about drip feeding, then it's not worthwhile holding money back from the market when valuations are high, because they tend to stay high for a long period of time. Another reason not to stop would be if markets are falling. The whole point of drip feeding is that if markets are falling, if anything, you put more in because you're buying more cheaply. So the only way this is going to go from now, Ola, is an acceleration of my asset purchases, my equity purchases, not a deceleration or a stopping or holding back. So when markets fall, that's the opportunity for getting higher long-term returns. So no, I'll speed up rather than slow down. And it'll be based on valuation if I do that. But at the moment, I'm still not accelerating because markets still aren't that cheap. They haven't really fallen that much. So there we go. There's my answer. Next question is, please do like our stream. It helps us. Even if you're watching in playback, that's really going to help us. So the first question is from, I'm still on screen capture. Here we go. Okay, let's go back to that. Yeah, so the next question is from Salty Rob, who says, can you explain cumulative, discrete and annualized performance figures, which is most useful in comparing investments? Okay. So one way to do things is to plot versus a benchmark. And the benchmark that you usually use would be for global equity. It depends on the type of fund. If it's a bond fund, you'd compare with a bond, global bond fund, say. Usually a fund will tell you what its benchmark is. So for example, if it's a global equity fund, it'll be MSCI ACWI, if it includes EM. If it's a US fund, it'll usually be the S&P 500. So just try to use something appropriate for the benchmark. One way to do the benchmark is simply divide the value of your fund by the benchmark and just look to see what happens over time. If it's increasing, it's beating the benchmark. If it's decreasing less than unity, then it's underperforming the benchmark. So it's a really easy way to compare versus the benchmark. Another way to do it is to just take daily returns and subtract the daily returns of the benchmark from the daily returns of your fund. And then you'll see whether it's outperforming or underperforming. But I think the division of one index over another is the simplest way to compare. And the other thing you might want to look at is whether the long-term performance justifies holding one fund or another. So the longer the period you compare for, the better. Over short periods of time, 1, 2, 3 years, it's fairly noisy. So really you want to compare over, say, 10 years or more if possible, if you've got enough data. In fact, I got some stick recently because I was comparing I did a kind of facetious tweet where I was comparing Fundsmith Equity, which is a very popular UK equity fund, and I compared it with MSCI World. And because it's screwed up with PayPal and Facebook, it had very large positions in those two, it effectively lost 3 years of alpha. So I said, happy third no alpha birthday with, 3 cakes. So that upset a lot of people. But I mean, normally I'll compare over a much longer period. And to be fair, Fundsmith has actually performed very well over a very long period. What's worrying is that recently its outperformance has started to effectively disappear for a 3-year period. And since I did that tweet, because PayPal and Facebook have fallen even further, the underperformance has gotten bigger. So it was just neck and neck with MSCI World and Sterling at that point. Now it's even underperforming more. So yeah, but preferably you should compare over a longer period of time. The longer you can, the better. So I hope that helps you, Salty Rob, if you want to compare performance. Next question is from Vanessa, who says, Evening, Vanessa. Financial and business news talk about the severe chip shortages all the while. Shouldn't semiconductor ETFs be going to the moon? They've been trading sideways for 1 year or so. Yeah. Well, I think one thing to note is that generally these markets are forward-looking. So things like Nvidia have done incredibly well. Let's have a look. Let's have a look at Nvidia just to show you what I mean. It has outperformed incredibly, but then it turned out to be a bit of a round trip since the beginning of this year. So let's have a quick look at that. Let me just share, and I've got to remember not to unshare at the end of it. There we go. Here we are. So this is Nvidia, and you can see it rose 59% over the course of about a month and a half. I think that was at the end of last year. So a huge surge at the end of last year, but then it gave almost all of that back again at the beginning of this year. So yeah, I think if you look at the performance over a longer period, it has actually done very well. So let's look over 5 years. So you can see it has had an incredible performance over the period since 2020. So will it fall further? Possibly. I mean, the valuation probably now is very high. So I think what you're seeing, Vanessa, is a period of very strong performance, and now it's starting to tail off. And any kind of underperformance or non-spectacular performance in earnings is being hugely punished at the moment. So that's something to be cautious of as the euphoria comes out of markets. Because good, strong earnings growth is great, but if a large part of the price of the stock or the index is due to euphoria, that can disappear literally overnight, or in the case of a month, as we can see here with Nvidia. So that's why earnings are important, because they provide a kind of fundamental safety net for any particular stock or index, where if it does fall below a certain valuation, then fair valuation, then lots of people will come and buy. But if it's hugely overvalued, it's got a huge price to earnings multiple, then that support is much lower than the current price. So that's why suddenly people have realized valuation does matter, and a lot of these low profit or even unprofitable companies have suffered hugely as a result. But even great companies like Nvidia has suffered, where a lot of the pricing and the multiple was due to the narrative being very strong, and that just pushed up the valuations. Right. So I hope that answered your question. We've got a super chat from Jason. Thank you very much, from Canada. Thanks very much, Jason, who says, thoughts on investing long term in ticker SPXL, which I'm Googling. So SPXL, I think, is one of the 3 times multiple. Yes. Okay. Right. So this is the direction 3 times. Oh dear. I don't want to subscribe. No. Okay. So let me share my screen again. I'll bring up this screen so you can see. Right. So this is the fund in question. So this is a 3 times levered, well, 3 times daily ETF. Now what that means is that you get 3 times the return that you get on the S&P. So if the S&P goes up 1%, you get 3%. If the S&P goes down 2%, you lose 6%. And it's only on daily returns. What that means is that you never get back less than you put in. So if you put in 100, the worst that can happen is that it falls to 0. Whereas with leverage, raw leverage, you can actually have less back than you put in. So you can end up owing money to your counterparty. Whereas with this thing, that can never happen. The worst that can happen, you lose 100% or close to it. Because when there is a sharp drawdown, say a 50% drawdown in the S&P, these things can lose more than 90% quite easily. Now in a bull market, nobody thinks about that. So people are happy to have the leverage. In a bear market, everyone remembers why leverage isn't such a good idea. So yeah, I mean, if you're confident that the S&P is going to go up in a trending market, this kind of thing might be interesting. But for a long period of time, I'd be cautious about having a big exposure to this ETF unless you can leave it for the next 20 years. If you did that, it would probably be okay. But just bear in mind that with this thing, if you backtest it and reproduce the results you would have got between 2000 and 2012, there'd have been a 98% drawdown. In other words, if you'd have had $100,000 in 2000, you'd have had $2,000 left in 2012, roughly. I think it was a bit before that, actually, 2008, 2009. And that's because of the leverage effect. Now, if you'd have held on to it, you'd be fine. You'd have made back your money since then, and you'd be beating the S&P again. It's just that it's a terrifying ride. So if you've got the stomach for it, and you've got the discipline not to sell, and the honesty to admit you can't time it, because a lot of people think, oh, I'll get the leverage while it's going up, and then as soon as it goes down, I'll stop being exposed to it, I'll sell it. Well, guess what? You often won't be able to time it quickly enough, and then you get all sorts of cognitive biases thinking, well, I'll hold on to it a bit longer because it'll probably bounce back, and then maybe it doesn't. So yeah, don't fool yourself, and be honest about how to win with this kind of fund is all I'd say. Right, so not a huge fan, I've got to say, although I have held something similar myself for short periods of time, and I did pretty well with it, more by luck than judgment, I have to say. Right, so back to this. Right, so back to the YouTube questions. Don't forget to like and subscribe and listen to our podcast. And subscribe to us on Twitter as well, because we're at PensionCraft on Twitter, and we'd like to have more people follow us there because I spend a lot of time on Twitter. Okay, next question is Alex Smith, who says, "Hi Ramin, you invest via dollar cost averaging, but your videos explain that lump sum tends to be better. Is that because of current high valuations and hence lump sum may be best in general, but not now, or something else?" Well, I've got to say, Alex, the reason why I do it is to overcome my own fear, because I'm very cautious. So to me, buying into a very expensive market is, like trying to put your hand in a fire. It's very difficult for me to do that because I can see the valuations are very high and it just goes against my grain. So the way I forced myself to do it was to do videos showing it was optimal to do that. So I convinced myself by doing the back tests that showed that valuation's a terrible measure to time your contributions, and that it's much better to just simply drip feed into the market long term. If you do have a lump sum, better to lump sum invest most of the time, unless you're very unlucky and it's just before a crash. But certainly for drip feeding, withholding money is not a good idea. So why am I drip feeding? Because of my fear. And it's my way of overcoming my fear and forcing myself to buy even when markets are expensive. And, it is kind of paying off now because I'm buying at a cheaper price than I would have 3 months, even 6 months ago now. So that's been a good thing. But it could have gone the other way. It could have been that markets kept on grinding higher and I'd have been better off simply buying at the beginning of the period rather than drip feeding. So, the reason why I chose a 2-year period was because I thought usually when there's a shock to the system like the pandemic, it takes a little bit of time for the market to realize the problems. And often there are scandals and kind of fallout from a shock. And indeed, there have been some. No big ones, I have to say, not yet. But I think things will get a little bit more choppy in the near future. But anyway, I'm not going to hold back my investment if that happens. I'll buy more because it'll be cheaper. So I hope that answers your question, Alex. Next question is Tim M, who says, "Did I get right from one of your videos that when inflation is above 5%, stocks underperformed? So cash would have better in those environments historically than equity. Cash would have been better than equity. Thank you." Yeah, so generally what happens is if inflation, and this is simply an empirical fact, right? So you plot the Shiller price to earnings ratio on the y-axis versus year-on-year inflation on the x-axis. Both sets of those data are available in Shiller's spreadsheet, so it's easy to plot one versus the other. And what you see is a kind of pointy hat, Mexican hat kind of shape, or a Gaussian if you're a physicist or a mathematician. So it's a kind of pointy hat. So around 2 or 3% inflation, valuations go up. And that's the kind of peak valuation. That's where people are willing to pay most for every dollar of earnings. If you get deflation, so negative inflation, or inflation around 4% or 5% or even higher for a long period of time, then equities usually derate. The multiple falls. So that's why the peak is around 3 or 4% for inflation, 2, 3, 4. And then once it reaches 5%, it starts to fall again and equities sell off. Similarly for deflation, equities sell off historically. So what's weird at the moment is that inflation is in the US 7.5% and valuations are still pretty high, very high by the Cape measure. So that's why if they stay high, if inflation stays high, I think it's very likely that we'll get a derating of equity. The reason why is usually margins suffer for companies if inflation stays very high, because people generally will suffer due to the inflation because they have less discretionary ability to the household income will effectively go down because living expenses increase. If that happens, then earnings usually fall for companies because people can't spend as much, and economic growth is slower as well, which isn't a good backdrop for equity. And then prices also go up for companies. So if they can't pass on those price increases to their customers, then their margins decrease and their profits decrease. So this is the kind of unpleasant set of circumstances when you have very high inflation for a long period of time. Now, at the moment, companies still seem to be able to increase their margins or at least keep them constant. That seems to be the case right now in the US, also in the UK so far. At a certain point, when disposable income falls and all of the savings from the pandemic are wiped out, that's not going to be the case. People won't be able to consume if prices are too high. And there, people, I suspect, companies will have to cut margins. So that's the place where we're headed, I suspect. If inflation does stay high for another year, say, very high, then it's going to be a problem for equity. And coming as it does at the same time that people in the UK, for example, are talking about raising taxes and, growth isn't great at the moment. So, I suspect there could be a confluence of various bad outcomes. But still, you've got to be optimistic. Most of the time things aren't that bad. And at the moment, we're still in reasonable good growth across most of the developed world. Earnings are kind of okay still. Margins are still very high in the US, for example. Many people are saying they're going to come down, but it hasn't happened yet. But that's certainly something to watch. So I hope that explained your question. I hope that answered your question, Tim. Would cash be better? No, because if inflation's very high, then cash isn't a great place to be. All I could say is that you'd lose less money with cash than you would with equity if it crashes. So is cash a good hedge? Probably better than long duration bonds if inflation is very high. But still, there is no great hedge. Gold is probably one of them in a very high inflation, low growth environment. So the next question, let me just check if anyone of our members... Oh yeah, we have a question from Gary, who's one of our long-term supporters. His crown is red, which means he's been a supporter on YouTube for a very long time. Topical. What's your opinion of Jeremy Grantham? A visionary or a chronic alarmist who's inevitably correct every once in a few decades? In fact, our video for Saturday is exactly on that topic, Gary. It's all about Jeremy Grantham and what he's been saying about a super bubble. Now, a lot of his points are interesting ones. And Laura and I watched a couple of his interviews, and Laura really likes him, I've got to say. She wants to invite him for dinner. So if you're listening, Jeremy, you're welcome to dinner in Amersham. But he's a really interesting guy. He's been around the block many times, and he's called a lot of these bubbles correctly in the past. Yes, he is a broken clock in the sense that he's often bearish. But look, he's been running money for so long, and you can't run money and be successful by being bearish all the time. So he's long some of the time and in certain sectors and in certain types of stock. So he must have got a pretty good record despite all the bearishness that he puts out in the media. Certainly at the moment, though, his point is that, we've got 3.5 bubbles, bonds, equity, housing, commodities is the half. And yeah, anyway, I strongly recommend you watch the video. I'm not as bearish as him. I think he is a little bit too bearish, but yeah, we'll just have to see whether things do kind of steady a bit later on in this year, or whether this sell-off is going to continue. But I think one thing I do disagree with him about is that he's saying that you can dodge a bullet. He's saying that when markets fall, you're better off selling rather than just holding on. Because there have been periods in the past where you'd have been underwater for, in Japan, you'd have been underwater still. But for global equity, that's not true. You'd have been better off holding on and, in fact, buying more. In fact, most people are in the situation where they're still earning still saving, and they should still be incrementally investing. And especially if markets fall, you should be investing even more. You should be reaching down the back of the sofa, and particularly after a heavy fall, when valuations are low, that's when you should be investing as much as you can, because that's your opportunity of a lifetime, or maybe a couple of times in a lifetime. So it depends on how low the valuations go. But Jeremy Grantham, yeah, interesting guy, big philanthropist, which I love, very into sustainable investing, which is interesting. So he's made a big donation to Imperial College, which was my university. I went to my degree was there at Imperial in London, my degree in physics, and my doctorate in physics was there as well. And he's made a big donation to Imperial for their environmental research. So looking at sustainable investing, but also sustainable living, I guess. So there's a Grantham Institute, I think, but it's named after him. So great guy, very interesting. And I just love the way he explains things very calmly. It's not about emotion really for him. It's more about drawing analogies with the past. But maybe too bearish, I think, certainly from my point of view. Next question is from the Yidman Momentum, who says, DCA, heard about this. Can you make a short video? I heard that it beats normal dollar cost averaging. Oh, right. Momentum dollar cost averaging. I haven't heard about that. I guess the idea is that you dollar cost average more when markets are rising, and then you dollar cost average a little bit less when markets are falling. I haven't heard of it. Interesting. But I'll certainly have a look at that. That could be an interesting strategy. Right, next question, also from one of our supporters, is from Dan Veneri, who says, my employer matches my pension contribution. That's awesome. What do you think is the best percentage to invest in my pot? How much should I have in my pot when I'll retire? Yeah, I mean, this is a kind of trade-off thing, isn't it? How much do you live now and how much do you save for retirement? I think that's one of the reasons why it's good to have a plan, and also figure out how much you want to have in retirement and when you want to retire. So if you have a spreadsheet where you can, work out how much your investments will be worth in the future, assume the equity goes up at 6%, something like that. You can always try different growth rates. Assume your living costs will increase at roughly 2% per year, or whatever you want for inflation. And then just see what point you're going to reach when you've got enough in your pot to survive the rest of your life, probably. You also have to know your life expectancy. You'll know when you've got enough. And at a certain point, you have comfortably enough, potentially. But having the spreadsheet will tell you if you have enough. So it's not worth guessing. Just do the sums. It's not that difficult. Literally just have two columns in the spreadsheet, two assumptions, investment growth rate, inflation, and then how much you want to spend in retirement. So that's probably the best way to do it. Work out your enough and you'll know when you've reached it. And also build in some margin for error as well, because you don't want to get it wrong, right? You don't want to walk into your boss's office and quit and suddenly realize, oh, I haven't got enough. Can I have my job back? But, as much as you can is generally the answer until you reach enough. Because the sooner you put the money in, the greater the compounding effects and the less contributions required over the long term. But if your employer is matching your contributions, that's great. Many employers do that, and it'll provide a big boost, particularly early in your career when the compounding effects are the biggest. So that's good, Dan, that you're doing it. But just do the sums and you'll see when you have enough, would be my advice. So the next question is from you on YouTube. So our supporters have run out of questions. Don't forget to like us. That helps us a lot if you do that. And you can do that in replay as well. And you can subscribe to our channel too. And the next question is from Jay. Oh no, we've got another one from Anna. Anna, who says, some people say growth tech stocks are cheap or even value now. What indicators can we look at to confirm or refute that before investing in confirm or refute that before investing in a small cap growth tech ETF? Yes, let's just look at Kathy's fund, ARK-K, and just look how it's faring. Now, at a certain point, Kathy's fund has been really beaten up. So here's ARK Innovation. This is the primary ARK fund, and it's now down 56%. And it does seem to have stabilized a bit recently. Obviously today it took a bit more of a tumble because small cap growth fell. But yeah, it's down hugely. It's not back to where it started. A lot of people have been overlaying what happened in the dot-com bubble with what's happened to ARK since it rose to a peak and then fell. And they do overlay each other very closely up to this point in time. And people have pointed out that the dot-com bubble went much further, so it would fall back to where it was previously before the pandemic. So, is it cheap now? Well, I think one way to look at that is go to Yardeni and have a look at value versus growth PE. So this is the document I'm thinking of. Yardeni research is great because they publish these, they update them daily. And have a look at growth and value. So I'll just make sure I'm sharing this properly. I think, yes. So this is the forward price to earnings multiple for growth in blue and value in red. Now, of course, growth is always a higher valuation than value. By definition, value is cheap stocks, so the valuation will be lower. But the key thing is the dispersion between the two. Notice how during 2000, for example, people were paying far too much of a premium for growth. So the dispersion between growth and value was huge at that point, and of course it compressed to its long-term average. Currently, again, you can see that even, this is on the 15th, so 2 days ago, so it won't be very different. There's still a big premium for growth. People are still paying a huge premium for growth relative to value. So has this got further to fall? Well, yeah, to fall back to the long-term average, which I'd say is probably a multiple of maybe, 3 or 4 between the two on average since 1995. I think it's got further to fall. So it's certainly not the case that, this is back to kind of the normal growth value dispersion. So I think this is probably a good way of monitoring it. I wonder if there are any other graphs. Yeah, so this is the difference between the two. So I guess it's one minus the other here. And long-term average looks like it's 1.2. Oh no, it's actually marked on. Oh no, that's a ratio of 1. I'd say the long-term average is about 1.25, just eyeballing it. And currently it's 1.5. So will it fall? Probably. I think it could fall further. But it's certainly a lot closer than it used to be. Yeah. Oh, this is the spread between the two. Yeah. So that's the one I'd probably look at. So let's go back to, I'm going to have a swig of my drink. Anyway, I hope that answered your question, Anna. Next question is from Jay, who says, you mentioned in one of your excellent webcasts, thank you, Jay, that one of Warren Buffett's reasons for success is leverage as owning insurance companies. Yeah, why an insurance company means leverage. Okay, so remember, Jay, that leverage is just investing money which has been given to you, which you've borrowed. Now, how does that work with an insurance company? Well, an insurance company has float. So they just collect money on premiums in the good times, and then if something bad happens, they have to pay out that float to the people who are making the claims. That's what an insurer does, after all. Now, in the meanwhile, they can take some of the float and invest it. So effectively, you're investing. Let's say your company has $1 billion. If you've got $1 billion in float, well, effectively you've got leverage. So is it leverage? Not really, because that is money that is effectively owned by the company. But you could describe it as leverage, in the sense that it's not money that they can necessarily spend. They have to have some safe cash or kind of cash-like investments where they can turn it into cash very quickly to pay out their insurance claims. So that's where the leverage comes from. And that's what's led to very good returns in the past, because he could invest the float. And he's been doing that for 50 years. And so, if he didn't have the leverage, it certainly wouldn't have been such high returns. But of course, he's a very good stock picker as well. Let's not deny him his glory, because he's earned it. So that was what we were saying, Jay. I think you're talking about the podcast there, because it was one of the dumb questions of the week, where Michael asks a question which is usually not dumb after all, because it's often got some really interesting reasons behind it. So which one is that? I think that was Bubble or Nothing. That was episode number 2. There we go. So yeah, do listen to our podcast if you haven't already. It's quite entertaining. I just hope it's as fun to listen to as it is to record with Michael. So the next question is from BMBM365, who says, we've seen a record number of UK mid and small cap acquisitions by foreign and private equity. What do they see so much value? Why do they see so much value, but retail investors don't? Yeah, I suppose with an acquisition, it'll usually happen when valuations are low, as they are now for the UK, and usually it'll be they'll cherry pick companies very carefully. So in order to have a very high rate of acquisitions, doesn't have to have a very high rate of acquisitions, if you know what I mean, because usually the rate of acquisitions is quite low. They're only a handful every year. So to double them is not surprising. So given the valuation of the UK relative to the rest of the world, I think it makes sense that the rate of takeovers is higher than usual. Does that mean that the broad market is also very attractive? It certainly means that it is attractive. It is less expensive than the US. But the UK has historically been cheaper than the US almost all of the time, at least over living memory. And the reason for that is that the earnings growth has not been great in the UK relative to the US, particularly over the last decade. But there certainly is value in the UK. It's certainly cheaper. And this is one of Jeremy Grantham's points, which is that Japan and the UK are two of the cheaper markets globally now, certainly compared to the US. So, I think, it is a cheap market. It does give you a high dividend yield. Those are the two attractive things about the UK equity market. To get domestic exposure, you should probably go for something like the mid caps, the FTSE 250, rather than the FTSE 100, which is heavily into miners and into banks and a little bit of pharmaceuticals as well. It's got a heavy overweight in those three, and it is very commodity dependent, which itself might be a good thing at the moment. So just look at the exposures that the two indices, the FTSE 100 and the FTSE 250, give you, just to check that you're happy with that. But if you are, then certainly it's one of the cheaper markets, and usually that means higher returns long term. So I think the UK is attractive for those reasons, as long as it can get its act together and maybe increase the growth that it generates long term, and move away from this culture of paying out high dividends, which I think is probably quite old-fashioned. Also, the sector composition has almost no tech. That's another thing which has made it unattractive until recently. But of course, all the big sell-offs at the moment are in the tech sector. So, maybe this is the time for the UK to shine. Who knows? But I think that's the kind of strong case for the UK. Those are the reasons why some people are choosing now to buy the UK. But there haven't been big inflows yet, I don't think. Next question is so we've got 15 minutes to go, and we've got a super chat from Jason. Thank you, Jason. Another Canadian. Thank you. It's Jason. It was Jason before. Thank you, Jason. And Jason says it took 25 years for the market to recover from the 1929 crash. If something similar happened today, where would you park your money? So you're right. If you were unlucky and you put all of your money into the equity market in 1929, then you'd have had a long drawdown period. But the thing to remember is that people didn't do that. Some of their money would have been put into the S&P, or whatever the stocks were at that time, well before 1929. So certainly for people who piled in at exactly the wrong time when there was euphoria, it was a terrible time. But for the people who had been investing for decades previously, the losses wouldn't have been that bad. And you certainly would have recovered much more quickly for your entire portfolio than the people who'd piled in right at the top. So I think the lesson from that is don't pile in when there's euphoria. Just keep drip feeding in all the time, because valuation, as I say, is a very poor measure for timing. It is not a timing indicator. But if something happened similarly today, where would I keep my money? In equity, because there'd be a very sharp crash. There'd be a long period when markets were not rising much. Nobody would be interested in investing in equity. Valuations would be low. And so let's have a look at the multiples at that time, just so we've got the kind of numbers in front of us. And this is the website I want. Right. So let me just switch back. Here we are. So this is the CAPE measure for valuation. So we're talking about 1929 here. And there was a long period when valuations... So I think this is not CAPE. Let me just get the CAPE ratio. Yeah, so this is Shiller CAPE. This is Black Tuesday when we had that huge fall, 1929. Now my point is that people would have been investing, say, since 1910 at very low valuations for the period up to 1920. So although the euphoria would have felt great, the crash would have felt awful, but they'd have been okay. But you can see that the valuations picked up pretty soon. There was a spike in 1933, I think, fell back again, and then it rose again towards 1937. Then we had the Second World War, when valuations were low again. So I guess my point is that when valuations are low are the times when you should be investing as much as you can, because every dollar you invest at these super low valuations will give you much higher returns over the next decade. So that's what you'd be doing. So what I'd be doing if there was a similar crash to where there was here is I'd be heavily investing during the crash. Well, if it happens, you'll see me do it. So that's the plan. And it's not easy to do because nobody will be investing at that time. On TikTok talking about buying stonks, there won't be people on Reddit forums talking about investing. It'll be something else. And I think that's what makes it difficult to be a contrarian, because you have to go against the tide. But I think that's what really discriminates between people who will do well long term and people who will get burnt during periods of euphoria when they pile in and sell when markets fall. That's exactly the behavior you don't want to have. At least that's what history teaches us. So I hope that answers your question. And let me just check that. Yes, I have switched back. Good. So the next question, which is please do like, share, subscribe if you are watching this on replay as well. And the next question is from Apothesis, who's one of our regulars. I definitely recognize your name. And they say, why are markets so schizophrenic nowadays? It's like every bit of news causes people to jump ship. A true rat market. Oh, I like that. Rats leaving the sinking ship. I think people are very jumpy for a number of reasons. You get long periods when you've got a market rally, like we had after 2009. We had about a decade of stability, low inflation. There were scares along the way, but generally things were fine, and there was a very strong trend. Then you get periods which are kind of like a turning point, where the macroeconomics changes and people feel the inflection. And when inflections happen, people get scared. The inflection at the moment, of course, is monetary policy. So monetary policy is reversing. We're seeing central banks increase interest rates. We're getting the pandemic surge in inflation, which nobody likes. And at the same time, people are talking about tax rises. The fiscal stimulus that we saw during the pandemic in many cases is reversing. So instead of seeing a year-on-year increase in government spending, we're seeing governments tighten up their belts, and the fiscal stimulus is now going into reverse. So that confluence of factors, people seeing higher costs of their daily cost of living, they're seeing euphoria coming out of markets. You can see why people are nervous. And then all it takes is some kind of war threat in order to destabilize markets further. So I can see why people are nervous, but just bear in mind that this nervousness is something you can monetize if you've got the strength to do it and the ability to be contrarian. If you've got the capital to invest during these market sell-offs, you'll be in good shape. So just bear in mind that contrarian is a good way to think. And you should always be thinking, is this a short-term effect? So war, generally, awful though it is often a short-term depression of valuation. That's what it usually creates. Fear, a kind of spike in fear. We had a sell-off in 2018 for various reasons, but that was a good opportunity to buy. We had a big sell-off due to the pandemic. Again, a good time to buy. So I think you should be thinking about how to monetize these short-term corrections and think about whether it is short-term or whether it will last a decade. And certainly at the moment, I think many of the factors which are driving markets down are temporary in nature. So I'm not that worried about them. And I still see them as an opportunity to invest more. That's why I think, make use of the fact that other people are rats, and you be the contrarian, and make use of that and monetize the fact that other people are jumping ship. Yeah, Mr. Market at the moment is kind of getting nervous, and if he's nervous, then you should be buying from him because he's selling to you at a lower price. And I think he'll probably get quite a bit more nervous over the next few months. Certainly not looking very rosy at the moment in terms of risk appetite. Next question is from Francisco Castro, who says, "Hi Ramin, what would a war in Ukraine do to the market?" Okay. Well, usually war is short-lived. That's my point. So I think it'll be bad in the short term. But remember, what really affects markets is how they affect profits. And you've got to think to yourself, will a war in Ukraine negatively impact US profits? Given that the US is almost now self-sufficient for oil, the answer is almost certainly no. In fact, if anything, it'll be good for US and particularly the energy industry, which will have a higher price for oil as a result of the Ukrainian crisis. So that's why I think every war is different, and you've just got to try and think through the immediate effects and say, is this creating a short-term opportunity for me? and where will the greatest opportunities be given the nature of the crisis. That's usually the best way to be tactical about these things. But de-risking during these short-term crises is usually a bad idea. Next question is from Seb Fox. Let me just check members. Oh, here we go. Question from Stephen J, who is a member, who says, since you said the UK is made up a lot of mining stocks, what do you think about the future for mining stocks? Well, at the moment, certainly, commodities are just on a tear. So, that's been a very good play. So that could short-term be good for the FTSE 100 in particular, which is very commodity heavy. So, that could be a tailwind for the UK and for miners generally. And I'm still long commodities, but directly via a commodity ETF, which optimizes the roll cost, which we've talked about in the past. So, I think being long commodities is still probably a good place to be at this point in 2022. We're still seeing commodity prices being pushed up. I mean, the baton changes hands between different commodities. Lumber went crazy, it fell, it's risen again, and now we're seeing energy prices surge again. So, I still think the commodity space is an interesting one to be in 2022. At a certain point, it's going to ease, but we still seem to be a long way off that. So maybe the UK's mining exposure will be a good thing at the moment, and probably be a tailwind for the UK. To answer your question, Stephen, and thank you for supporting us, Stephen. Next question, we've got 4 minutes. We've got time for one more question, I think. Right. Next question is from Seb Fox, who I almost answered previously. With US equity valuation so high, is it time to consider having a larger relative percentage of your portfolio in the more undervalued Asian markets, e.g. China, Japan, Korea, Singapore, and Southeast Asia? That would be part of the allocation. But remember, that's not the only regions which are cheap. Turkey, also very cheap for a very good reason, obviously. Inflation at 40% is not healthy for any economy. But this is what I meant about being tactical. Look to see whether you think the current crisis, which is pushing the valuation down in that country, is short-lived. If it is, then that could be a good tactical opportunity. So if you think the situation in Turkey is about to be resolved, or even not very soon resolved, if it won't get much worse, and you're willing to hold on to your Turkish equity for a decade, maybe this is an opportunity. Turkey. Another country that's cheap is, the UK is kind of in the middle, I'd say, in terms of Cape measure. But there are other countries which are also cheap. Russia, for example. You'd have to be very brave to buy Russian equity at this point, but it is a cheap market. So really it depends on what your kind of long-term view is about whether the situation's about to be resolved. China as well. Do you think that China will continue to sabotage its own equity market by creating new legislation which makes certain sectors no longer as profitable? If you think that they're about to end that purge, then this would be a great time to invest, because companies like Alibaba look very cheap. So, I think if you've got that conviction, I'm not sure I do, but if you have that conviction, that's certainly a good time to invest in those countries. But that's the kind of opportunity you should be thinking about. And if you are a long-term investor, you probably will be okay, whatever happens, unless the country fails. If the state fails, then and the equity market just fails to come back, right? You could have a Japan, you could have a Spain, you could have a Greece, where you have a decade of no recovery, if you're unlucky. So just be aware of the risks with all these tilts. Don't take too much of a risk. Don't bet the farm on Turkey, because it could go wrong. But if you just want to tilt your portfolio, maybe add a bit of extra return and have a bit of fun in the interim, yeah, have a tilt, but don't go all in on one of these bets, because it probably won't end well. It may not end well. And it's all about risk management, right? Don't take too much risk that you don't have to. And most of us don't have to. So there we have it. I think we're just about finished. It's just turned 8 o'clock. Thank you all for joining us. As I say, listen to our podcast. I think you'll like it. Michael is a genius coming up with the titles. It's not ESG being green. Reference to Kermit the Frog there. I loved it. And also like our channel, like this stream, subscribe to our channel, join our membership. It's very friendly. You get to learn lots, and you also get to support us, or just support us on YouTube if you like. Follow us on Twitter. Anyway, have a great 2 weeks, everyone, and looking forward to speaking to you again then. Let's hope markets are better by then, and good luck with your portfolios. Take care, everyone.